What's up, y'all? So in this video, we're going to be going over the basics to market structure. If you're familiar with market structure, this is going to be pretty basic. So as far as our market structure, in our uptrends, we have higher highs and higher lows. In our downtrends, we have lower highs and lower lows. So an uptrend will create a high and a low and will fail to get lower than this original low. So that's our higher low. Then as we break structure and we get above this peak, we've now created a higher high. And we return back, we fail to get below this low, we have a higher low, and then higher high, higher low, higher high. So our downtrend, we're going to have the opposite. What we're going to have is our lower highs and lower lows. So right here, we're going to have this original high and original low. It's going to fail to take out the high. So that's going to be our lower high. Then when it breaks below this low, we now have a lower low. Trades back up, fails to make it above the high, lower high, breaks down, creates a lower low. Again, I want you to understand that this does not become a lower high until this lower low is broken. Once that low is broken, we can now confirm this as a lower high. So our key market structure levels, we're going to have a short-term high, an intermediate-term high, and a long-term high. So the short-term highs are just going to be our higher highs and higher lows, right? But we're not differentiating them based on that. All we're looking at is, was this a swing point? Yes, we made a market turn there. Then we failed here, so this would be a lower high. Then we break above, this would create a higher high. What we're looking at them now is we're just looking at them as short-term swings. And so what is an ITS? An ITS is going to be our intermediate term swing. We create an intermediate term swing when two short-term swings have been broken. So you see we reached above this short-term swing, then we broke below this short-term swing. So this now becomes an intermediate term swing. Once we broke this low, this was just considered a short-term swing. Now, once it trades above this high, this would flip and then be considered an intermediate term swing. Now, intermediate term swings are going to be where a lot of our trades originate from after liquidity has already been taken. So again, that one would flip to an intermediate term swing because it is now taken out two short-term swings. Now we also have a long-term swing, and it can get a little more complicated. You don't have to write down every single one, but I would go through it as a drill on the higher time frame and look at these swings. So a long-term swing is the same as an intermediate term swing, but it's just the next level. So a long-term swing is a swing that has taken out two intermediate term swings. So again, an intermediate swing takes out two short-term swings. A long-term swing takes out two intermediate term swings. And that is going to be our market structure basics. Don't put too much emphasis on these. I would watch this video twice too because it's actually pretty short. But go through your charts and look for these levels on the higher time frame. It's not necessary to understand these exactly as far as what every single swing is. It's just building a base and a framework on where the majority of our trades are going to come from and how liquidity is being transferred, right? A long-term swing is probably going to have a lot more liquidity stacked behind it. An intermediate term swing is probably going to have the mid-level of liquidity stacked behind it, and a short-term swing probably isn't going to have as much liquidity stacked behind it.